So, Ihu, what's the one question you've never heard a client say?
Hardies, I wish I could pay more taxes.
Not once, not from business owners, not from executives, not even from people retiring with 5, 20, or 50 million rand portfolio. Now, let's be clear. Tax is important. It funds roads, it funds hospitals, it keeps the economy functioning. But there's a big difference between paying tax and overpaying tax. Because every rand that we save in unnecessary tax is rands that can accumulate in our pockets. More lifestyle, more security, more travel, more generosity, and more legacy. And that's what intelligent retirement planning is really all about.
Over the next few episodes, we're going to unpack the exact tax vehicles and strategies that we use for some of the most successful South African families and retirees that we work with. We're going to cover offshore wrappers, local tax wrappers, tax-free savings accounts, strategic use of retirement annuities, local trust structures, and offshore trust structures. And in the final episode of this series, we're going to unpack one of the most misunderstood retirement tools in South Africa, Section 10C, the disallowed retirement contribution, a strategy many retirees are sitting on without even realizing it.
If you're new here, I'm Hardy Swart, founder of Family Wealth Custodians, and today I'm joined by fellow senior financial planner Hugo Kloppers. Together, we help South African families build retirement plans with purpose. And as always, this video is for educational purposes only and doesn't constitute personal financial advice. Let's start simple. An offshore tax wrapper is essentially a life policy structure that holds offshore investments. Instead of you being the taxpayer, the policy becomes the taxpayer. That's the key shift. Normally, if you open a discretionary offshore investment account, you personally are responsible for capital gains tax, dividends tax, interest tax, provisional tax calculations and reporting. But where inside a tax wrapper, the structure calculates and pays the tax internally.
And that's why this matters. For high-income investors, the internal structure can make a meaningful difference over time, especially when the marginal tax rates are high. And here's a helpful way to think about it. A discretionary offshore account is like driving your own car. You handle the admin, the reporting, and the tax, everything. A wrapper is like having a structured handle the tax engine for you. You still own the investments, but the tax mechanics are handled internally.
Now, here's where the confusion creeps in. People hear offshore endowments, others say offshore sinking funds, and they assume they're completely different vehicles. Structurally, they are slightly different. An endowment usually has a life assured attached to it, where a sinking fund typically does not have a life assured. It's purely an investment policy. But from a tax and investment perspective, they function very similarly. So don't get stuck on the terminology. What really matters is the mechanics, the tax rate inside the structure, the liquidity rules, and the estate planning implications.
Let's talk about the part everyone actually cares about, tax. Inside most offshore tax wrappers, capital gains are taxed at an effective rate of 12%, and income is normally taxed at 30% inside the wrapper. But here's the important nuance. The providers we use structure this in a way where there's effectively no income tax impact because the unit trust funds inside the policies are rolled up funds, also called accumulating fund classes. So instead of paying income out every year, the return is reinvested inside the fund, which is then also effectively taxed at 12%. Now just remember, the exact tax outcome depends on the underlying funds and how the provider structures distributions, but this is the general framework. Now compare that to investing personally at your top marginal tax rate.
Let's make this real with a practical example. Let's say Jack worked in Dubai for a couple of years, where he earned good money, and is now retired back in South Africa. Over and above his South African investment portfolio, he's sitting with approximately $1 million in an offshore bank account. Now, here's the part many people miss. Because Jack is a South African tax resident, SARS taxes him on his worldwide income. So if that 1 million rand is earning interest in the bank, even though it's offshore, that interest is taxable in Jack's hands here in South Africa. And if Jack is paying tax at the top marginal tax rate, being 45%, 45% of that interest will be taxed every year. Now compare that to an offshore tax wrapper structure where the tax inside the wrapper is effectively capped at a much lower rate. This is the difference between 45% and roughly 12%. And if Jack isn't sitting in cash, let's say he's invested in growth assets like offshore equity, then the tax comparison changes slightly. In his personal name, capital gains could be taxed at an effective rate of up to 18%, where inside the tax wrapper, capital gains will be taxed at an effective rate of 12%. So in Jack's case, the tax wrapper can reduce the tax drag either way. On cash or interest, it will come down from 45% to approximately 12%, where on growth assets or capital gains, it will come down from 18% to 12%. Over a 15 or 20-year period, that gap compounds into real money. Not a small difference, a meaningful difference in what he can spend, give, and enjoy in retirement. So for someone like Jack, the question becomes, do we leave it as an offshore cash and bleed tax, or restructure it into a long-term offshore wrapper aligned to his plan?
And that's the key point. This structure is most valuable for investors in the higher marginal tax brackets. So how would we use this for someone with a 26% bracket?
Well, Hugo, most probably not, but it does depend. If you're in a lower marginal tax bracket, a discretionary offshore account might actually be more efficient from a tax point of view. But there are various other factors that we have to consider, especially from an estate planning point of view as well. And at the end of the day, there's no one size fits all. Every client situation is unique. Now, here's the trade-off. Most offshore tax wrappers come with a 5-year restricted period, and the exact rules can vary slightly depending on the provider or platform you use, but the principle is the same. In the first 5 years, access is limited. Typically, you can withdraw up to your contributions plus roughly 5% compound growth per year. Most structures also allow one policy load or one surrender during that initial restricted period. But once you pass the 5-year mark, the wrapper generally becomes fully liquid and you can access the investments far more freely.
And that restriction exists because this is legally structured as a long-term insurance policy. But with proper planning, you can stagger contributions across different policies over time, so liquidity events don't all fall in the same year.
Before we continue, can I ask you a quick favor? When we look at our channel stats, roughly 70% of our regular viewers aren't subscribed yet. So if you value quality, practical content focused on retirement planning and investing for South Africans, please do us a big favor. Hit the subscribe button, and if you want to make sure you don't miss an episode, hit that bell icon. It generally helps us reach more people who need this kind of guidance, and it helps us keep producing content like this every week. Alright, let's get back to it. Now, this is where offshore tax wrappers become very powerful. First, you can nominate beneficiaries, and on death, the policy can pay directly to those beneficiaries. If it is structured correctly, it can also avoid unnecessary executors fees, which in South Africa can be a meaningful cost. Now, here's another big advantage. If there's a nominated beneficiary who chooses to continue with the policy and they stay invested in the same underlying funds or shares, then there's no capital gains triggered on death. The base cost effectively rolls over. And that's a massive win for intergenerational planning. There's another big benefit that people underestimate. If beneficiaries are nominated, the proceeds often don't get frozen in the deceased estate. And that's not a small thing. My own father's estate took more than 3 years to finalize. That's 3 years where the money was stuck inside the process, and families can't access the funds that they need. So anything that improves liquidity and certainty at death is incredibly valuable. Now, here's a third layer, and this is where offshore gets serious. The offshore tax wrappers we recommend are typically domiciled in Guernsey, and if the policyholder was a South African resident when they passed away, no foreign inheritance taxes are payable on that policy because Guernsey currently doesn't levy inheritance tax. That matters because many people invest offshore in their own name and don't think about one thing: situs tax. Situs tax is effectively a form of inheritance tax if you have equities in America. Now, this is a real risk area, so always get specialist cross-border advice. I recently sat with a client who has about $500,000 invested in a share portfolio, mostly US equities, in his own name. What he didn't realize is that if he passes away, a portion of that US-held share exposure could potentially be subject to US estate tax, like I said, situs tax, and that can be as high as 40% depending on the circumstances. So this isn't just about returns and performance, this is about structure. It's about protecting the family from delays, friction, and surprise taxes when it matters most.
And estate friction is something people underestimate. Simplifying estate flow can be just as valuable as reducing tax. And for cross-border families, that simplicity can be priceless.
We typically consider offshore tax wrappers for our clients when the client is in a high marginal tax bracket, when the investment horizon is normally longer than 5 years, when offshore exposure is strategic and not tactical, and when the client or their family is looking for estate planning efficiency and less administrative drag.
So this does not make sense when liquidity is needed, your tax bracket is low, the investment is short-term, and flexibility is priority number one.
And here's the thing, oftentimes we find that the best strategy is actually a combination of the two. Some money in discretionary offshore accounts and some money in wrappers. Structure is about optimization, not ideology. Offshore tax wrappers do not increase returns. They improve your net outcomes. They cap tax, they simplify reporting, they improve estates flow, and they reduce friction. For the right investor, that difference compounds into freedom. For the wrong investor, it creates unnecessary restrictions. The key is not the product, it's the planning.
If you're investing offshore, would you prioritize flexibility or cap tax and structure? Drop a comment below. We read and reply to them.
If you would like to go deeper and understand exactly how offshore tax wrappers could form a key part of your retirement strategy, then schedule a complimentary exploration call with one of our retirement specialists. The link is in the description below. Thanks for watching. I'm Hardy Swart.
And I'm Ifu Kloppers.
This is Family Wealth. Keep investing into your future.